Welcome. Today I am talking about the five more factors of the interest rate. So here are the five most factors of the interest rate that we'll consider when dealing about the mortgage. First of all, I will talk about the interest rate. Interest rate is playing pivotal role while availing any mortgage. What is the interest rate? Now I am talking about what is the interest rate. The interest rate is the rate on your mortgage that significantly affects your monthly payment and the total amount that you will pay over the life of the loan. The lower interest rates mean the lower monthly payment, and the less interest rates mean the interest rate paid overall less. So it is a very crucial to shop around the best rate and find the best interest rate dealer. Now I'm talking about the second term, that is the long term, which is the length of the loan that is playing also significant impact on your pocket. So when the we talking about the long term, it's mean that the length of the loan that you have to repay the mortgage. Common terms of the mortgage that are considered are 15, 20, or 30 years. A shorter term typically results the higher in the monthly payment, but the lower overall interest cost, while the terms mean the lower monthly payment, but the higher total interest that will be paid. Now we're talking about the third down payment. Third type, that is the down payment. Down payment. What is the down payment? Down payment is the initial upfront payment that is made when we purchasing a home. So a larger down payment usually leads the lower interest rate or the lower interest rate that you will have to pay. And additionally, there is a minimum down payment that will be required is the 20%. The 20% are or more often to eliminate the need for the private mortgage insurance that called the PMI. So which can save your money in the long run. So the down payment also playing an important factor while we availing the loan. Means that we higher the down payments, the lower the interest rate that we will have to pay. Now we are talking about the credit score. Credit score, that is the most important factor for the mortgage. It is also called the fourth most important factor while availing mortgage. Your credit score plays a significant role in determining the interest rate that you have qualified for the mortgage. So, higher credit score typically results a lower interest rate as well, while lower scores may lead to the higher rate or difficulty qualified for a loan at all. Means that if your credit score is low, so you will face difficulty to pay the or avail the mortgage, or you have to increase the down payment. So it is essential to maintain the good credit score by paying bill on time, keeping credit card balance low, and avoiding availing opening new credit card account before applying the mortgage. Mean that it is considering that your profile will be the heavy or more effective for the mortgage. If your credit score will be low, then mortgage amount will be the less in order to avail any mortgage. Now, we are talking about the factor 5, which is debt to income ratio. Lender also consider your debt to income ratio, that is called the DTI, which compared that your monthly debit payments to your gross monthly income. A low DTI ratio indicates that you have to more income to available to cover your monthly payments or the mortgage payments, making you more favorable borrowers. It is generally recommended to keep your DTI below to that 36% to qualify for a mortgage. Although specific requirement may vary depending on the lender and the loan program. So these are the five most factors that are considered to available anymore. Now here are the three more factors that are also considered while we dealing with the mortgage. That is called the type of mortgage. So in order to availing the mortgage, we are thinking about which type of mortgage will be available. So there are different type of mortgage available, each with its own terms and features. Common type include the fixed rate mortgage, where the interest rate remain constant throughout the long term, and the adjustable rate of mortgage, that is called the ARM, where the interest rate can fluctuate periodically based on the market condition. So other options include the government-backed loan, that's called like the FHA, Federal Housing Administrations, or VA, Veteran Affairs loans, which may offer the lower loan payment requirement or the other benefit for the eligible borrower. Now we are talking about the second term, that is called the closing cost. Closing costs are the fees associated with the finalizing the mortgage loan and the transfer of the ownership of the property. These costs can include the loan orientation fees, appraisal fees, title insurance, attorney fees, and the many more. It is important factor in closing costs when budgeting for a home purchase, as they can add several $1,000s to the total cost of buying at home. So, some lender may offer to roll closing costs into the loan or provide assistance with the closing costs. So, be sure to explore your options. Now, third factor that will be affects your mortgage is the prepayment penalties. Some mortgage may come with the prepayment penalties, which are fees charged if you pay off the loan early to make extra payment beyond the certain limit. So, prepayment penalty can limit your flexibilities of the loan and increase the cost of the refinancing or selling your home before the end of the loan term. Before signing a mortgage agreement, be sure to ask about any prepayment penalty and consider how they may impact your plan for the future. So, here are the most basic things about the mortgage that we talk about in this video. So, keep in touch. Bye bye.